Good morning, everyone. Dan Macknick here from Willis and Macknick Financial Services. Listen, I wanted to jump on a quick video this morning. I've gotten a lot of phone calls about concerns around the contagion possibly resulting in Silicon Valley Bank's failure and insolvency. So I wanted to give just an update. What happened? What does that mean for the rest of the industry? Why did it happen? And what can we potentially see ahead? First of all, we do think that the insolvency at Silicon Valley Bank is an isolated incident. We don't foresee it translating or being contagious to other financial institutions out there. And one of the main reasons that I think that's the case is there were a couple of unique things that happened that caused Silicon Valley Bank, or SVB, to be insolvent. The first is that their mix of customers was much more tilted toward business clients than it would retail, husband and wife, son and daughter customer deposits. And because of that, cash needs of clients tend to be a little bit different. So the other thing that made it unique is in 2022, as we all remember, the Federal Reserve increased interest rates to a large extent, attempting to stem the tide of inflation against the broad economy. When that happens, as you all remember from our discussions that we've had, as interest rates rise, the value of bonds tends to fall. And what banks like SVP sometimes do is they take some of their customer deposits and they invest it in what they consider very safe investments. In the case of SVB, they bought a whole bunch of treasury bonds. And they bought them a year and a half ago, before that rise in interest rates really took hold and drove the value of their bond portfolio lower. Okay, so then as a result of the economy, a lot of SVP's clients, their business clients, they needed extra cash, so they didn't deposit as much as SVP thought that they would. And as a result of that, they had less cash on hand with which to manage their deposit liability. So if a client comes into a bank and they request their money, the bank is obligated to deliver that. And SVP just didn't have a lot of cash on hand to meet those obligations as a result of owning too many treasury bonds. So to help with that, what SVP decided to do was sell a portion of their treasury bonds. And when they made that decision to sell, they had to sell those bonds at a loss of value because, as you remember, interest rates came up, the value of their bond portfolio fell. When people saw that occurring, it caused a bit of a panic, and SVP's clients ran to the bank, tried to get their money out. That results in insolvency, illiquidity, and then finally insolvency. SVP did make some mistakes. When they bought their treasury bonds, they did so for periods of time that were longer than they should have been, meaning they bought bonds with maturities that were out into the future farther than they probably should have been. The result was that they had to sell those things at a loss. What happened as a result? So the federal government stepped in, the FDIC, the Treasury, and the Federal Reserve, and said basically, look, no matter if you were above the FDIC insured limit at SVP, we're going to guarantee all of your deposits, Mr. and Mrs. Customer. So what that did was effectively, it assured SVP's customers that they were going to get their money out. Now, if you owned a bond in SVB or you owned common stock in SVB, you're out of luck, as you well know, because this is an insolvency event. So, but with the federal government stepping in and guaranteeing those deposits, it allowed people some level of comfort with the fact that they weren't going to lose everything. The federal government went one step further and said, okay, if there's any other financial institution out there in the United States that run into liquidity issues, we're going to go ahead and provide a loan program for them for the next year, whereby if you experience a run on bank assets and a lot of your customers come in and try and get their deposits out and you don't have the liquidity to meet their demand, you can go to the Fed and they will loan you money, which in effect guarantees deposits across the country for a period of time. So would this have been an issue had the federal government allowed SVP to simply fail and allowed people to lose their money? Yes. Would it have been akin to something that we saw in 2008? Probably not. We don't think it was that systemic to be contagious to some of the larger financial institutions out there. So we want to keep this in perspective. At the same time, I wanted to give you an explanation of what happened, why did it happen, and do we expect to happen again? And the answer to that is decidedly no, we don't. I think there's going to be some stringent analysis of the rules required for smaller and intermediate sized banks to keep a certain level of deposit assets. But that said, I hope this gives you a level of comfort today. We did notice that inflation was still relatively high as the numbers were reported today, right in line with expectations, but still a 6% year over year increase in consumer price index. So it's our hope that the Federal Reserve remains true to its mandate to reduce inflation and continues this interest rate increase cycle. We'll see how that goes. But if there are any questions, feel free to reach out to our office. We're happy to talk to you about this. And I hope everybody has a great day and a great rest of your week. Thank you.